Hello everyone and welcome back to this exercise series for chapter 10 of our managerial accounting course ACCT 428. In this video we're going to be looking at exercise 10-13A, so let's read the question together. It says Curry Company has an opportunity to purchase a forklift to use in its heavy equipment rental business. The forklift would be leased on an annual basis during its first 2 years of operation. Thereafter, it would be leased to the general public on demand. Curry would sell it at the end of the 5th year of its useful life, and the expected cash inflows and outflows are laid out in this table right here. Okay? What's required? A. Determine the payback period using the accumulated cash flows approach. Okay, so let's start with that. Now to do the accumulated cash flows approach, we're going to need to list our inflows and outflows year by year, okay, with the exception of the initial investments or the initial cost of the equipment, right? So maybe do something like this, the number of year right here, and then the item, okay, and then the cash flow generated or paid out for that item, and finally we have one more column, we'll call it accumulated cash. All right, so starting at 2018, we'll ignore the purchase price for now. We have revenue, which is expected to be $30,000. And so far, the accumulated cash is going to be $30,000. Right? And then for the following year, 2019, we also have a revenue, but this time $40,000. The accumulated amount so far is going to be 30 plus 40, that's $70,000. And then for the following year, 2020, another revenue item, this time for $28,000. So that's going to be $98,000, okay, which we have already crossed or exceeded the initial cost of the investment, which is $86,000. But we also need to consider that here we have a cash outflow also on the same year that the company is expected to pay out for a major overhaul. So again in 2020, major overhaul of $12,000. We'll put it in brackets because this is a cash outflow, and we'll deduct it from here, and that will give us $86,000, which is identical. Let's change the color. Identical to the equipment's costs or the purchase price of the equipment, of the forklift, right? So from here, we can see that the payback period is going to be 1, 2, 3 years. So after the first, second, and then third year of 2020, the company would have paid back their initial investment, right? So we can say something like the payback occurs at the end of the third year. Okay, and that's what's required in the first part, Part A. Now let's see what Part B wants. It says determine the payback period using the average cash flows approach, which is the second approach that we've learned for the payback method, and round your computation to 1 decimal place. Okay, so let's do that. Now, the average cash inflow is computed by adding or summing up all of the cash inflows and outflows, again, except for the initial cost, right? And then dividing these by the duration of the, or the lifespan of that investment, right? So we'll say average cash inflow is going to equal, let's zoom out a little, see if we can get this all in one frame. Right, so it's going to be equal to $30,000 plus $40,000 plus $28,000. Okay, minus $12,000, which is the cost of the major overhaul, and then plus another $20,000. I was hoping I can get this in one line, but let's drag it a bit to the left, see if we can fit. Okay, and then plus 14,400. Okay, plus last one, 9,600. Okay, and then we take all of this and divide it by the number of years, which is 2018, 19, 20, 21, 22. That's 5 years. Okay, we go to our calculators. 30,000 plus 40,000 plus 28,000 minus 12,000 plus 20,000 plus 14,400 plus 9,600. That's equal to 130,000 divided by 5, and that's going to be $26,000. So equals $26,000. This is the average per year, the average cash inflow per year. Okay, and that means we can now calculate the payback period by dividing the initial investment, which is the initial cost of the forklift, right here, $86,000. We're using the same formula that we applied previously, by the 26,000, which is the average that we just calculated. Okay, so $86,000 divided by $26,000, that's going to give us 3.3076. So we're going to round to 1 decimal place, just like the question asked us to do. So that's going to be 3.3 years. Okay, and that is going to be the payback period using the average cash flow method. All right. I hope that you found this video useful. If you have any questions, please feel free to drop them down in the comments. This is how we have approached exercise 10-13A. Until I see you in another exercise video, take care.